In 30 hours, silver didn't just fall, it collapsed through every support level traders thought was untouchable, from $121 to the mid-70s, the largest intraday destruction in recorded history. But here's what nobody's telling you. While the charts were bleeding, physical bars in Shanghai were trading at premiums Western markets couldn't explain. The crash wasn't random, it was mechanical. And if you don't understand what just broke in the leverage structure, the next move will break you. Welcome to John Analyst. I'm here to walk you through what institutions saw and what the headlines won't tell you. If you've been in markets long enough to remember when clarity mattered more than noise, hit that subscribe button. This isn't entertainment. This is strategic intelligence for people who make decisions, not excuses. And drop a comment. Tell me where you're watching from. Because what happens next in silver isn't just about silver anymore. Let's begin. Silver experienced its largest single-day intraday price collapse in recorded trading history. Within 30 hours, the market moved from a nominal high of $121 per ounce to an intraday low in the mid-70s. This was not a correction. This was a structural breakdown in leveraged positioning. And understanding what broke and why is the difference between surviving what comes next and becoming collateral damage. Let's reconstruct the timeline. Early morning, the market printed a new nominal high. Traders were celebrating. Social media was flooded with price target predictions. Everyone felt certain the move had more room to run. But certainty is when markets punish hardest. Within hours, the first wave of selling began. Not slow, not measured, violent. The initial drop triggered stop-loss orders, automated exits that traders had placed to protect profits. These weren't decisions. These were mechanical executions. And once the stops started triggering, the cascade accelerated. Here's what most people miss about modern silver markets. Silver isn't just a physical metal anymore. It's a layered paper structure. Futures contracts, options, synthetic swaps, structured notes, leveraged ETFs. And when that structure gets overloaded, it doesn't gently unwind. It collapses like a shelf breaking under too much weight. The second wave wasn't retail panic. It was dealer hedging. When options dealers sold call options during the rally, they hedged by buying futures. But when the rally reversed, they no longer needed that upside protection, so they sold futures to rebalance. That selling pushed prices lower, which triggered more stop-loss orders, which forced more hedging adjustments. It's not conspiracy, it's mechanics. Then came the third wave, the killer, margin calls. When volatility explodes, brokerage firms demand more collateral. When exchanges increase performance bond requirements, which they did, brokers demand even more. If traders can't post additional capital, they don't choose to close positions. Positions get closed for them. That's why liquidation events always look like stampedes, because they are. By the time the market reached the mid-70s intraday, the system had flushed out every participant who was trading on borrowed capital, tight stops, or emotional conviction without risk management. The violence wasn't limited to silver. Gold dropped hard. Platinum followed. Mining equities sold off across the board. This was a precious metals volatility event, not a silver-only event. And the gold-silver ratio told the real story. During the rally, the ratio had compressed, meaning silver was outperforming gold. The ratio pushed down into levels not seen in years. But during the crash, the ratio snapped wider again. Not because gold was suddenly stronger, but because silver was the crowded side of the boat. And when the boat tips, the crowded side goes underwater first. Now here's the part that separates informed capital from everyone else. After the collapse, the commodity exchange adjusted margin requirements on silver futures contracts. This isn't unusual. Exchanges do this when volatility exceeds normal parameters. But it confirms something critical. The system felt stress. The clearinghouses, the risk managers, the institutional infrastructure all recognized that the move was extreme enough to require recalibration. That tells you this wasn't just traders taking profits. This was forced deleveraging. So let's be precise about what actually happened. Phase 1, profit taking from early buyers who entered months ago, normal behavior. Phase 2, stop-loss cascades from leveraged traders who thought momentum would continue, predictable. Phase 3, options dealer hedging adjustments as implied. Volatility collapsed and call protection became unnecessary. Mechanical. Phase 4, margin calls and forced liquidation from participants who could not meet collateral requirements. Systemic. By the time Phase 4 completed, the market had purged the weakest holders. But here's the question nobody's asking yet. If this was purely a paper market event, why didn't physical silver get cheaper everywhere instantly? Because it didn't. While benchmark futures prices were collapsing on Western exchanges, large bar premiums in key Asian markets remained elevated. Physical buyers in regions with industrial demand weren't celebrating lower prices. They were still paying premiums to secure immediate delivery. That's not supposed to happen in a market crash. When prices fall, everything should get cheaper. But physical supply chains don't operate like electronic screens. Metal doesn't teleport. Shipping doesn't accelerate. Procurement contracts don't cancel themselves because a futures trader in New York got liquidated. And that divergence between what the chart said and what physical buyers were actually paying is where the next part of this story begins. Because the crash revealed something most market participants don't understand. Silver trades in two different worlds. One is the paper world, fast, leveraged, liquid, and brutal. The other is the physical world, slow, logistical, contractual, and inflexible. And when those two worlds disconnect during extreme volatility, somebody makes a fortune and somebody else funds it. While traders in New York were watching their accounts implode, buyers in Shanghai were paying premiums that made no sense. At least not to anyone who thinks silver is just one global market with one global price. But that's the illusion. Silver doesn't trade in one market. It trades in two parallel universes that occasionally collide. And when they do, the friction creates opportunities that institutional capital exploits systematically. Let's talk about what actually happens when a paper market collapses, but physical demand doesn't disappear. The morning after the crash, large industrial buyers in Asia were still procuring 1,000-ounce bars. Not at distressed prices, at premiums. Why? Because a solar panel manufacturer in China does not care what happened to a leveraged futures trader in Chicago. They care about one thing, keeping production lines running. And if the alternative to paying a premium is shutting down a factory, they pay the premium. This isn't irrational behavior. This is supply chain economics. Here's the part most analysts miss. Physical silver moves slowly. When you buy a futures contract, settlement happens electronically, instantly. When you buy a 1,000-ounce bar in one country and ship it to another, you're dealing with logistics, customs, insurance, vaulting, and delivery timelines measured in weeks. That time lag creates arbitrage, and arbitrage creates profit. During the crash, benchmark prices on Western exchanges dropped $40+ an hour. But the Shanghai Gold Exchange, where physical delivery actually occurs, showed a completely different picture. The spread between Shanghai and New York widened. That spread is called a premium. And when that premium stays elevated even after a violent price drop, it's telling you something. It's telling you that physical buyers with real-world needs are still bidding aggressively. Now let us talk about backwardation, because this is where the market screams at you in a language most people don't speak. Backwardation happens when near-term futures contracts trade at a premium to deferred contracts. In plain language, the market is paying you more to deliver silver today than to promise delivery 6 months from now. That's the market yelling, "I need metal now." And even during the crash, pockets of backwardation persisted in specific contract months. Why? Because industrial users can't wait. Electric vehicle manufacturers, solar companies, grid infrastructure projects, they operate on production schedules, not price predictions. When they need silver, they need it on a specific date. If it's not there, production stops. And the cost of stopping production dwarfs the cost of paying a premium for raw material. So while speculators were being liquidated at losses, industrial buyers were locking in supply at whatever price secured delivery. That's the divergence. That's the two-world structure. Now let's get tactical, because this is where understanding structure becomes profitable intelligence. The most visible silver inventory in the world sits in COMEX-approved warehouses in the United States. That inventory is divided into two categories. Eligible. Metal, stored in the warehouse, but not available for immediate delivery against futures contracts. And registered. Metal that is available for immediate delivery. The registered category is what matters, because that's the metal that can actually be demanded by someone holding a futures contract who wants physical settlement instead of cash. And here's what the data shows. Registered silver in COMEX warehouses has been trending lower for months. Not collapsing, not gone, but directionally shrinking. At recent count, registered silver hovered around 100 million ounces. That sounds like a lot. Until you realize that global silver demand, industrial plus investment, runs well over 1 billion ounces annually. So the registered buffer represents roughly 1 month of global consumption. And it's declining. Now inventories can be replenished. Metal can move between categories. Scrap can come back into the system. The market is adaptive. But adaptation has a speed limit. And when price moves this violently, speed becomes everything. Here's the part that creates real tension. During the rally, metal was flowing out of Western warehouses and into Eastern markets. Large bars were being purchased, exported, and delivered into regions with structural physical demand. That flow didn't stop during the crash. In fact, it may have accelerated. Because when Western prices collapse, Eastern buyers with hard currency see an arbitrage opportunity. They buy metal at temporarily depressed benchmark prices, ship it to markets where premiums remain elevated, and capture the spread. This isn't theory. This is documented trade flow data. And it's why you can have a chart that looks like a disaster while physical metal continues moving from west to east at elevated real-world prices. Now let's talk about lease rates, because this is the silent indicator that reveals stress. Silver lease rates measure the cost of borrowing physical metal for short-term delivery. When lease rates spike, it means someone desperately needs metal right now and is willing to pay a premium to borrow it rather than buy it outright. During periods of physical tightness, lease rates can surge even when paper prices are stable or falling. Why? Because the paper market and the physical market operate on different supply-demand dynamics. Paper supply is theoretically unlimited. You can create synthetic exposure through derivatives. Physical supply is finite. There are only so many bars in vaults available for immediate delivery. And when those bars start moving out of accessible inventories and into private hands or industrial consumption, the physical market tightens, even if the paper market looks calm. So here's what the crash actually revealed. The paper market is fragile, leveraged, prone to violent liquidation. The physical market is sticky, logistical, resistant to instantaneous repricing. And the gap between those two realities is where informed capital operates. While the crowd panics over chart patterns, institutional buyers are watching warehouse data, lease rates, import-export flows, and physical premiums in delivery hubs. Because those indicators tell you what's actually happening in the real economy, not what's happening in a leveraged trading account. And right now, those indicators are not showing relief. They're showing tension. There's a narrative circulating in precious metals markets that refuses to die. It goes like this. Silver demand is irreplaceable. Supply is structurally short. Therefore, prices can only rise. It sounds logical, until you understand how industries actually respond when a critical input becomes too expensive. They engineer it out of existence, and that process is already underway. Let's talk about what happens when silver prices hit levels that trigger corporate survival instincts, because this isn't theory anymore. This is documented engineering pivot. In the past 18 months, major solar panel manufacturers, the single largest industrial consumer of silver globally, began publicly announcing research programs aimed at one goal: reducing silver content per panel. Some went further. They announced timelines for silver-free photovoltaic cell technology, not someday, not in a decade, within the next 2 to 3 years. Why? Because when silver hit $80, then $90, then pushed past $100, the economics of solar panel production fundamentally changed. A solar company operates on margin optimization. If raw material costs spike to the point where panels become uncompetitive against alternative energy sources, the company either adapts or dies. Adaptation means substitution, and substitution means demand destruction. Now here's the critical nuance most precious metals analysts ignore. Substitution doesn't happen overnight. You can't redesign a solar cell in a week. You can't retool a factory in a month. You can't validate new technology, secure regulatory approval, and scale production in a quarter. Industrial adaptation operates on 12 to 24-month cycles. But once the process begins, it's irreversible, because companies don't invest millions in research and development just to abandon the project if silver prices drop temporarily. They commit to the transition. And that means even if silver falls back to $60 or $70, the long-term demand trajectory has already shifted. Let's quantify what we're talking about. Solar panel production currently consumes over 100 million ounces of silver annually. That represents roughly 10% of total global silver demand. If solar manufacturers reduce silver intensity per panel by 30% over the next 3 years, which multiple companies have publicly stated as a target, that removes 30 million ounces of annual demand from the market, permanently. That's not a small number. That's equivalent to the entire annual output of a major mining jurisdiction. And it's gone. Now extend that logic to other sectors. Electric vehicles use silver in electrical contacts, circuit boards, and battery management systems. As EV production scales, so does silver consumption. But here's the question nobody's asking. At what price point do automotive engineers start substituting copper, aluminum, or alternative conductive materials? The answer isn't public, but the research is happening, because every automotive company operates with cost reduction mandates. And when a critical input experiences 40% price volatility in a single week, that input gets flagged as a supply chain risk. Supply chain risks get engineered out. That's not speculation. That's corporate procurement doctrine. Let's talk about historical precedent, because markets have seen this before. In the 1970s, copper prices spiked dramatically. Industries responded by lightening gauge, switching to aluminum in specific applications, and redesigning products to use less material per unit. Demand didn't disappear, but demand growth slowed significantly. And when prices eventually corrected, demand didn't come roaring back, because the substitution had already occurred. The same pattern played out in aluminum, nickel, and rare earth elements. High prices trigger innovation. Innovation reduces intensity. Intensity reduction becomes permanent efficiency gain. Silver is not exempt from this pattern. Now here's where the tension gets interesting. Substitution takes time, but industrial procurement operates on contracts, production schedules, and forward commitments. That means even as companies are engineering silver out of future designs, they still need silver for current production, right now. This creates a temporary window, possibly 12 to 18 months, where demand remains inelastic despite price levels that would normally trigger consumption reduction. During this window, manufacturers can't reduce their silver needs even if they want to. They're locked into existing designs, existing contracts, existing production commitments, so they pay whatever price secures delivery. But that window is closing, and when it closes, the demand profile changes. Let's add another layer, recycling. At $60 per ounce, recycling silver from industrial scrap is marginally profitable. At $120 per ounce, it's extremely profitable. Higher prices incentivize scrap recovery. More scrap recovery means more secondary supply entering the market, and secondary supply competes directly with newly mined supply. This is basic commodity economics, but it's often ignored in precious metals narratives because recycling doesn't fit the scarcity story. The reality is more complex. Silver recycling rates have been increasing, not dramatically, but measurably. And if prices remain elevated, or spike again, recycling infrastructure will expand further. That's additional supply that wasn't in the market 2 years ago. Now let's talk about the structural deficit narrative, because this is where misunderstanding becomes expensive. It's true that global silver markets have run deficits in recent years, meaning total demand exceeded newly mined supply plus recycled supply. That deficit was covered by drawing down inventories, and when inventories decline, the market tightens. But here's the critical distinction. A deficit is a pressure. It's not a countdown timer to zero. Deficits can persist for years without causing supply failures, as long as inventories exist and as long as price adjustments bring supply and demand closer to balance. And price adjustments happen in two directions. Higher prices incentivize more mining, more recycling, and more substitution. Lower prices stimulate more industrial consumption, more investment buying, and less scrap recovery. The market self-corrects. It doesn't move in straight lines. So when analysts claim silver must go higher because of structural deficits, they're ignoring half the equation. They're ignoring demand elasticity. And demand elasticity is real. Now here's the part that matters for decision makers. The crash we just witnessed happened during a phase when industrial demand was still largely inelastic. Manufacturers couldn't reduce consumption quickly enough to respond to price spikes. But that phase is ending. The next phase, where substitution efforts begin producing measurable demand reduction, is beginning. And if that phase coincides with continued high volatility or another price spike, the market could hit a ceiling, not because supply increased dramatically, but because demand stopped growing. Or worse, started declining. And that's the substitution threat. And it's not hypothetical anymore. It's engineered, funded, scheduled. The question isn't whether substitution will happen. The question is whether investment demand, speculative buying, strategic accumulation, monetary hedging, can offset the industrial demand reduction that's already in motion. If it can, silver trends higher despite substitution. If it can't, the recent crash wasn't the end. It was the beginning of a repricing cycle that most market participants don't see coming yet. Every major precious metals bull market contains a moment like this, a violent correction that looks terminal in real time, but later reveals itself as a mid-cycle reset. The 1970s silver parabola had multiple crashes before the final peak. The 2011 surge experienced liquidation events that felt like the end. The 2020 COVID collapse looked like systemic breakdown until it reversed within weeks. History doesn't repeat precisely, but the pattern is consistent. Leverage builds, leverage breaks the market, resets, and then the real question emerges. Do fundamentals reassert, or has the character of the market permanently changed? Let's examine what this crash actually accomplished. First, it eliminated weak positioning. Every participant trading on excessive leverage, emotional conviction, or tight stop losses is gone. Liquidated, margin called, stopped out. That's not tragedy for the market. That's a cleansing mechanism. Markets carrying too much leverage become unstable. They react violently to small triggers. They amplify moves beyond what fundamentals justify. And eventually, they collapse under their own weight. By forcing that collapse now, rather than allowing leverage to build further, the market may have created healthier structure for the next phase, if there is a next phase. Second, volatility has been recalibrated. Before the crash, implied volatility in silver options was elevated but manageable. After the crash, volatility exploded to levels that change participant behavior. Higher volatility means higher margin requirements. Higher margin requirements mean smaller position sizes. Smaller position sizes mean less speculative excess. Less speculative excess means the market trades more on fundamentals and less on momentum. That's a structural shift. Third, the crash revealed concentration risk. When a market moves $40+ in 30 hours, it exposes where capital was clustered. Institutional players now know where the weak hands were hiding. They know what price levels triggered cascading stops. They know where leverage was highest. And that knowledge becomes positioning intelligence for the next move. Now, let's talk about what didn't change. The crash did not resolve the underlying macro conditions that drove silver higher in the first place. Global debt levels remain at historic highs. Central banks continue facing fiscal pressures that make currency debasement the path of least resistance. Real interest rates, adjusted for inflation, remain in ranges that historically favor hard assets. And government deficits are accelerating, not shrinking. That backdrop doesn't guarantee silver rises, but it does mean the conditions creating precious metals demand, monetary uncertainty, currency instability, inflation hedging, are still present. They didn't vanish because a futures market had a violent liquidation event. Here's where context matters. In 2024, global gold demand hit record levels. Central banks added to reserves at rates not seen since the 1960s. Investment demand surged as institutional capital repositioned for a world where fiat currency stability is no longer assumed. Gold's behavior matters for silver, because silver tends to follow gold's narrative with amplification. When gold trends higher on monetary concerns, silver eventually follows with higher volatility. The relationship isn't perfect, but it's persistent. And right now, gold's fundamental bid hasn't broken, which means silver's story isn't over. It's just reset. Now let's address the banking sector signal that appeared at the worst possible time. On the final business day before the weekend, a U.S. regional bank failed. Regulators stepped in. Deposits were transferred. The usual script. But the timing matters. Bank failures don't happen in isolation. They happen when liquidity is tight, when asset values are under pressure, when interest rate environments expose poor risk management. And when bank failures occur during commodity volatility, it signals broader financial stress. Not panic, not systemic collapse, but stress. And stress creates demand for assets that sit outside the banking system. Physical gold, physical silver, hard assets that can't be bailed in, frozen, or restructured by regulators. That demand dynamic hasn't changed. If anything, it intensified. So here's the framework for understanding what happens next. The market now faces two potential paths. Path A, fundamental reassertion. The crash was a leverage flush. Investment demand returns as buyers recognize lower entry points. Physical premiums stabilize elevated, confirming continued structural demand. Warehouse inventories continue declining, validating supply tightness. Industrial buyers lock in forward contracts to secure supply, creating a price floor. And within weeks, the market begins another leg higher. This path requires follow-through. Physical buying must step in at these levels. Inventories must continue draining. Investor conviction must return despite the trauma. Path B, structural repricing. The crash exposed a fundamental shift. Substitution efforts accelerate faster than expected, reducing long-term industrial demand. Recycling scales up significantly, adding supply the market wasn't pricing in. Speculative interest fades as participants realize silver's volatility makes it unsuitable except for high-risk trading. Investment demand doesn't return with sufficient force to offset industrial optimization. The market enters extended consolidation, volatile, range-bound, without clear directional conviction. This path doesn't require collapse. It just requires stagnation. Which path is correct? The market will decide, not through analysis, not through forecasts, through observable behavior in the coming weeks. Watch physical premiums in delivery hubs, Shanghai, Singapore, Zurich. If premiums stay elevated despite lower benchmark prices, path A is active. If premiums compress quickly, path B gains probability. Watch warehouse inventories in COMEX approved vaults. If registered silver continues declining, tightness is real. If inventories stabilize or increase, supply concerns were overstated. Watch industrial procurement behavior. If manufacturers lock in long-term supply contracts at current prices, they're signaling concern about future availability. If they pull back and wait, they're signaling confidence supply will remain adequate. And watch investment flows. If capital returns to silver ETFs, mining equities, physical accumulation vehicles, conviction is rebuilding. If flows remain negative or stagnant, the market has lost its narrative. Those indicators will provide clarity within 2 to 4 weeks. Not certainty, but clarity. This crash revealed where the weak hands were positioned. The next move will reveal something more important. Whether the world is genuinely repricing silver as a strategic industrial input and monetary hedge, or whether the recent surge was speculative excess disconnected from durable fundamentals. The difference determines whether this crash represents a generational buying opportunity or the beginning of multi-year repricing lower. Markets don't announce their intentions, they reveal them through behavior. The crash flushed leverage. The next phase will reveal conviction, or the lack of it.